Dr. Leber, it's great to be here with you again. You're not alone. No, so please, all our colleagues from ACATIS, please get up so that we know who of us is there. Okay, it's they're in the last row. So these are all colleagues of ours. So I do not want to present them all individually, but you're going to have the opportunity to talk to them in the break. Okay, Dr. Leber, before you start, I like to talk to you. We're having a short interview in the beginning. So you have just returned from Omaha. I always think that it's very interesting, and so all media know that you're. So Warren Buffett is retiring. You're remaining invested. Yes, I'm still remaining invested in Berkshire Hathaway. This company is so stable. This won't break. And Warren Buffett says it's not about the jockey; it's about the horse that you're riding. And he will be missed, the same as Charlie Munger, who died 1.5 years ago. But the quality of the business model is great, and so I assume when Warren Buffett leaves, then the inner values of the company will become visible. It's actually, he as a person, he is the signpost, but the business below remains stable, and so I still think that this is a good investment. So one colleague here, Johannes May, who told me in the 80s, well, there is a person in Omaha who is interesting somehow, and 1990, I actually bought the first stock of Berkshire Hathaway for around about 10,000 euros. I can't hold them in parallel to my work at ACATIS anymore, but nevertheless, the return was great. So, what inspired you today to focus on the topic of risk today? So, risk, already as a child, at school we calculated horse bets and we won a little money, and in the 80s we bet on sinking prices, and with that we financed a journey to Kenya for us all, and so risk was everywhere always. And we Germans, many of us here, and also your customers are very anxious, and that's why we wanted to talk about German angst. So we're suffering a little in Germany from the fact that we don't tend to think ahead, that we cling to the present, and yeah. So a couple of days ago, I met a future researcher, and he opened up all the breaches that we have currently. So on a geopolitical level, things are happening, and we've got lots of there are lots of things happening, and we don't have the chance to try everything out. We really need to take a risk currently, or else we won't make progress. And for that, we need a different culture. And the question is, how do we get there? Yeah, well, so one thing that I'm going to talk about is, I'm going to look back in history, and I'm thinking about the Americans. These are, they all took a risk because they all left their country at some point, and they said, well, okay, I won't make it here, I'm going to have to take a risk. And so one example. So how can we get there in Germany? I think it's the courage that is somehow missing. So, So I just talked to a venture investor, and they said, okay, we've got 10 million customers. And how do we get to the 500 million right now? And Americans say, well, 500 million, I want it big, and I really want to conquer the world market. In Berlin, the VC entrepreneurs, they think if they have 10 million, they already own the entire world, but we really need to think big in order to reach our goals. Okay, just very briefly. The capital markets, in my opinion, they take into account too little risk. Well, there are different segments in the capital markets, and I think the public markets, they focus too much on the short term. And I would like to Yeah, I remember Omaha, and well, they can talk about the last quarter and can create bill-to-book ratio, but they can't tell you where the company will be in 5 years. And there are and this is always. Yeah, next week, this is the end of the quarter. This is always very short term. And here I see chances and risks. And my argument today will be, if you've got good stocks, you can take huge positions if you take your time with them. Okay, so we'll start. You're invited to also participate in the discussions. So you can always ask your questions. So please participate. And so the floor is yours. Okay, so I'll need to see to it that from a technical perspective, everything will work well. I've got lots of words and I've got little time only. So let's take the title. The title of the presentation is not from me. It's from our colleagues from marketing. Give risk a chance because progress requires risks. So we're not making progress if we're taking risk. Failure is part of the game, and there's lots of things that can be done in order to manage the ratio between risk and chance. So risk management, where does that come from? So I always like history. You know the ACATIS Fund. This is based on an entrepreneur of the 14th century, and I think we can really learn a lot from this person because this will really, these investors that they really took lots of risks. So what they did in order to create prosperity, that's way more than what Bill Gates does today. They really took lots of risks, and I'll get to that in a minute. So where are the good returns? I would like to talk about venture capital today. This will be this afternoon. This is not our topic, but this is nevertheless, this has to be part of a good portfolio. We will get into mathematics a little. This is also something that helps. And then after that, I'm going to present today's speakers. And I'm going to start with Lao Tzu. And so he said, the hard and strong will perish, the soft and weak will remain. And here I always think about the Germans and their savings accounts, and people cling to that, but people don't see how inflation eats that up, eats the money up. And so something that seems to be safe, but actually it is highly fragile. And so in the last century, in Germany, we had 5 different currencies, but Siemens, the Siemens AG has been in existence for more than 150 years. So what is durability? Many German or European companies, or also American companies like Coca-Cola, they have a long history, and they have endured lots of crises and presidents, and so the soft is that which I think is really the durable. But you will need to see what you pick, and that you don't set on the wrong plans, but that you set on the right plans. Okay, this can't be read. How am I going to do that right now? So it's way too small. So I'm just going to continue. So I'm going to explain it here. So you know that image, deficient frontier. You heard that. On the one axle, we have the risk that is often described as volatility, but volatility is not a real risk. This is only fluctuations, and you can also take the volatility of turnover of earnings. And then horizontally, you have the expected yield, and then you have the efficient frontier. This is this line, and here at the corner, this is the best point. This is the best point. I'm going to mix that, and so with credits or with cash, I'm going to create the correct allocation according to my risk profile. This is the theory, and as Warren Buffett said, okay, let's distribute the theory because there's so that we can work against it because there's lots of errors in there, and so basically what I do is optimizing errors, and then you have a result, and mathematics says, okay, well, this is the optimal solution, and in the end you only have only found the biggest error in evaluation, and so the during optimization, you always select the most dangerous point. And well, this is an interesting picture, and I wanted to prepare it. And actually, it only looked chaotic because in reality, the figures are not distributed as a cloud, but they're all over the place, to the left, not to the left, but below the curve. And well, in practical life, this is a nice model, but it's not really, it can't be applied in practical life. So I wanted to present it nicely, but it didn't work because it looked totally chaotic. And so Markowitz optimizes the errors in estimation, and so I said we would talk about mathematics a little too. So in Omaha, we met Professor Penman. He's an accounting professor from Columbia University. He created the Penman model that we are using in everyday life. And here we have the simple form that everyone can use because it is really very simple. So when I'm at a conference, and if I lead discussions, then I always make this little calculation in order to find out whether the discussion is even worth it. So we have two things. The equity return, so what does that, return on equity, so what return does that company make? And so at a return on equity of 40, then I have 2.5% of yields. So at a 10%, I have 10% of return, and this is something that is being delivered continuously, and and then we have the growth. Growth is okay. So book value growth here. This is where you ask, okay, how much has the price of a stock risen over the last 10 years on average per year? And so how do I combine those two figures? So via the price book value ratio, and so if I combine them, then I have the number one at the beginning, and this is the current return. And so if the ratio is more aggressive, so if I have to pay the book value twice, then I move 50% to the return on equity and the other half on growth. And and if there is no book value, then the weight lies always on the growth ratio, and and like that you can find out how much of a yield or return a stock will provide. So let's talk about Berkshire. Well, we're talking about Berkshire Hathaway here. So the earnings and so here we have, at Berkshire, we've got a yield of, or earnings of 88 million. So it's 2.6 billion. And well, the market value is 980 millions or 22 millions. And so I've got a return of 9%. And for Markel, it's 11.6%. So we'll talk about growth in a second. So
dann habe ich ein Ski geregelt, ja. Wie viel Prozent Gewicht lege ich And then I got a slider here. What percentage do I put on ROE and how much on growth? And that slider is book value to price ratio. Is at Berkshire 60%, at Markel 76%, because Markel puts much more stake on today's revenues and not on growth. So I multiply this, and at Berkshire I end up with a return of 9%, and Markel over the next years of about 11% every year. And I think that's nice returns. You would like to get them. How much you should do in the end is something you will hear at the end of the presentation. So this is just the estimate for the return over the next few years. It's quite simple and it works quite well. So calculate in a better way, that's one important topic. When I talk about risk and return, I have to get hold of the figures. If I can't do that, I shouldn't start. And then I look back into the past, and I'm always quite surprised of what happened. We have our role model, Francesco Di Marco d'Artini, who organized fleets in the Mediterranean with his kind of spy network, so to speak. He found out what are the prices for cloth or for textiles in Brooks, and he found out which is the fastest vessel and ship which could come through the Road of Gibraltar to Bruges and can report about the prices on the exchange there. And that's really interesting and really modern. And when you look at that time in England, there was a company of merchant adventurers for the discovery of regions, dominions, isles, and places unknown. That is how they collected money. And I think it's really interesting. I don't know where I'm going, but I already collect some money for the discoveries. And then you can compare it to Alphabet. That's quite similar. To organize the world's information and make it universally accessible and useful, to remain a place of incredible creativity and innovation that uses our technical expertise to tackle big problems and invest in moonshots like artificial intelligence. You know, my heart's opening up. But they've got all in front of them, discover the world. That is like in those times. So today's entrepreneurs are not so unsimilar to the ones at that time. Now, the modern era with discoveries of Columbus, I looked at his logs when he started. He went to the Potomac, I think, but was funded by the Spanish. He was an entrepreneur. He wanted to get part of the revenues of discovering India. So that is what he wanted from Spain. So he got in and he got out again, but it was profit-oriented what he did. And those people at that time invested really well into business intelligence. So navigation, cartography, for instance, when it's about Henry the Seafarer, then trade routes, weather conditions, market prices, and in parallel, the invention of accounting in Italy at that time. Let's have a look at it. This is a Dutch map. That's how they imagined Asia would look like. And this big chunk there, that is Japan. Then you see this very small part in the middle, that is Taiwan. And the shape wasn't really correct, but cartography, recognizing what I'm seeing, gathering knowledge about the targets I want to reach or the destinations I want to reach, that was important. Now, Henry the Seafarer issued questionnaires, which I found quite astonishing, for each and every port. What's the situation of the port? What's the position? Are there landmarks? Are there natural hazards like sandbanks? Is it possible to throw down your anchor there? Is there potable water? Is there wood? Are there workshops for ship repairs? Which goods come from where when you come to this kind of trading position? How about the military? How about the government there? Are there tariffs? What is their relationship to other European kind of powers? Are the indigenous people hostile or friendly, and so on? And I thought it was so incredible what kind of systematics the Portuguese came up with at that time. So what will I find there? Where should I actually have a settlement? And this is absolute on the same intellectual level as our way of doing it today. And then accounting, you have to be able to correctly calculate. And I think many of the companies simply vanish because they cannot calculate correctly. On the left side, you see Mr. Schwarz. I think Jakob Fugger is on the right side. On the left side, this is, I think, Matthias Schwarz. He was the accountant of Jakob Fugger. Jakob Fugger was the richest man in his time in the world, because he had an overview of the facts in his business. He knew exactly what's happening. So that was the modern controlling that he introduced in this time. And quite on the other side of things, that's the financial statement analysis by Professor Penman. And we were on the general meeting. Warren Buffett was asked how to analyze all this. And he says he loves to first read the balance sheet, not the P&L. And then he turns page by page and looks at every page of the business report is really relevant, and there's nothing you should just overlook. Professor Penman said in his book, page by page, read every page of the business report, and it could actually show some pitfalls or some problematic assumptions. So that's analogous to good accounting, and good accounting is the basis for making decisions. Now, what do I do with that? With the risk and the return, what can I do? I can also shift my personal risk acceptance limits. And this is illustrated here. So if I'm willing to take more risk, then the limit is shifted outwards, and I have a better opportunity for better returns. And let me go back to the Bible, very far back. In Matthew 25, in this parable, Lord gives money to his servants, and two of them invest and double it, and the third servant just borrows it, buries it. Now, and the Lord is actually praising the two first ones because they took the risk, and he reprimands the third one because he has not taken risk and was too cautious. And the end is because and those who have it, they will have everything, and the other ones will be taken from, and they shall be cast out into outer darkness. Now, we don't want to cast all the saving people in Germany out into outer darkness, but as the Bible says, as the New Testament says, take a bit of risk, it's good, and it's also accepted by God. And I think that is a good way of thinking. Now, there's another topic, which is diversifying and expanding your search room. And I come back to, I'll come back to that. First of all, Warren Buffett said you need a circle of competence. That is an area where you have, when you know what you're doing, that you understand quite well. And the early investments of Buffett, our industry colleague Kiefer Luo, really by shareholder value analyzed that, and he said he always took industries where everything was well known, like the railway system. There are 4 big railway companies in the United States, 2 in Canada added, and the mileage is known, the routes are known, the locomotives are known, and you can just simply calculate what is a burning of Santa Fe. So know the metrics. That's the most important thing. Have a good idea of the industry and who is the winner and the loser in that industry. And Buffett says, if you know that, if you know what you're doing, focus on that, what you know. And then you can actually even take big bets. So put big positions in, because you know what's really happening there. And he also says, on the other hand, diversification is a protection against ignorance. So if I have no clue, I will have to diversify. And that doesn't really make sense when I know what I'm doing. And this is why he says, for ETFs, for instance, those who don't have a clue, they should buy ETFs. It's not a bad thing to do that. It's just that with better knowledge, you can penetrate deeper into it and get out more of it than if you just invest broadly into the whole market. So those of you who don't have the know-how or no time or not a good funds manager, they would buy an ETF. And those who have got good fund managers would buy that fund. And if you have even more time, you go into the individual stocks. And that's what we are doing for you. And then something I found astonishing. In 2016, on the general meeting, Buffett talked about his circle of confidence. And I have read it again. He says only 5 to 10% of all companies are part of his circle of competence. And that explains why he missed out of so many interesting investments. Healthcare sector, Buffett has nothing in that. IT, he did Apple once, but that's not an IT company really, but a consumer goods company, right? And he never did Microsoft, he never did Google, he never went into Amazon, because that was outside his area of competence. And because of that, he missed out on big opportunities that he could have used if he had worked on his circle of competence. If he had said, I look at a different topic and I will work my way into it, maybe with Bill Gates, his good friend at his side, at least at that time. Please explain to me IT, explain how this works, how do I get market share, how is customer retention here? And Buffett could have expanded his circle of competence, but he didn't. And this is why we said in 2016 that was, we need to go our own way. We cannot just blindly follow Buffett. That is not our way. Our circles of competence are elsewhere, also in Europe, for instance. This is why we said we have to get lost, we have to get a bit away from the classical Buffett companies. I would like to mention private equity and venture capital here. The day before yesterday, I saw a presentation, and the number of companies at the stock exchange has been cut by half in the past few years. And it's quite easy to understand. Last autumn, I had a conversation with a company I'm very familiar with in Germany. They have a growth rate of about 30 to 40%, but it's not on the stock exchange, and because the stock exchange doesn't like that. And the CEO said, I want to go away from the stock exchange. It's really tiresome, because these analysts who always ask the same stupid things and they never understand the company, and they exit when there's a turnaround, that's not the investors you want to have. And then there's a new generation of young analysts coming in with, again, the same stupid questions. What will be the profit like per share in the next quarter of a year? Is it $2.16 or 17? But that's not to do with the long-term corporate development here. And he said, in private equity, I can take care of the business. I can actually not have to take, I don't have to take care of the stock exchange. I can actually have people who are with me in a smart way. And that explains why at the stock exchange, the number of participants is going back, because it's a tiresome business. Now, most of you are not on those conferences. And then I'm asking, well, is it strategic things? Is it technological developments, breakthroughs, new markets? And they always ask, is it $2.16 or 18 in the next quarter, you know? So sometimes it's really so stupid, but I wanted to talk about the strategy. And then I can leave the company in my portfolio for a few years. And private equity actually used that gap. Years ago, I talked to Thomas Jetter, an old colleague from McKinsey, who was for years at Palmyra, and he said in private equity, we get the right managers at the right place. And we can select worldwide the best managers and put them exactly where we want them. To do the financing in a completely new way, we can actually set up the company as an entrepreneur would do it, and not under the kind of forces of the stock exchange, do some short-term things. And I had a friend who was head of a big oil group in Europe, and years ago I told him, you are predestined to build up charging fuel stations. You've got the location, you've got huge cash flows. Why are you not being the industry leader for that? And he said it's not possible because the dividend requirements are too high and we don't have the money to do that. We have to pay it out. So you see the conflict between what the stock exchange wants in the short run and what an entrepreneurial thinking is. So a pleading for private equity and venture capital. And if you have a look, you really see there are higher returns there. Venture capital is right next to it, and we see here the listed ones, the private ones, and the venture capitals. You see the Europeans are not so bad, really. We usually think we are bad, but private equity and venture capital, we are more or less on the same level here. Regarding public equities, we know from the last year, of course, that the United States, because of the big IT companies, have generated huge cash flows, so they were in a better position. But in general, it's not so bad to invest into Europe. And look at the government bonds that you can see here and the corporate bonds. It's not really interesting, a bit, but not too much. And the really interesting things are going on in the private equity field. Now, there's some different things are important. Stock exchange protects from ignorance and stupidity. So if today you buy a house, for instance, there is a big chance that you will be simply that there will be a sham because everyone's working against you. There's a real estate agent who wants to get rid of it, and there's a seller who just used some paint for some to deceive some things, and then you have to pay the land transfer tax, and the first 10% off everything is gone. Stock exchange is fair. Stock exchange offers to everyone the same price, no matter if they're experienced or not. And you can exit it at any time. So the stock exchange is really, really fair. Venture capital is a different thing here. Here, the talents are quite different. At the stock exchange, you can achieve homogeneous results, but in venture capital, you can be between minus and super good performance. The range is huge. So you need the very best managers here. And that is why it's so important here in the top, to be in the top upper half or top quartile, if you want to look at venture capital or at others. So as a layman, you would be lost. You need a good family office or a very good consultant. Now, how do you get rid of the risk? We talked about performance, but how do I get rid of the risk? I can actually share the risk with others. And that's, again, in here, very small. How do I do this? I'll just zoom in. What we saw in the 14th century were consortiums. If you look at Venice, for instance, the Venetians, the people in Genoa, and here in Florence, for instance, they actually formed trading companies and sent out fleets together. So if something's happening, you can defend yourselves all together. You can also share the risks and the returns. Columbus was funded by a consortium of merchants and bankers. So again, the revenues and profits were shared, like the Spanish silver fleet. And then there was this kind of genius change into stock corporations. The first stock company or corporation in the world was the Dutch East India Company, VOC it's called. And if you're interested in that, it's a really, really exciting story. Who else is there? We've got other capital companies, the East India Company, the Eastern Company, the Levantes Company, the Russia Company, Turkey Company, Hudson's Bay Company. You can still see that in Toronto today. They went bankrupt twice, but still they exist somehow. Compagnie de Nouvelle-France, and others. Those are all stock corporations. And in the end, that made money available for large enterprises. And then in insurances, we've got the same thing. Lloyd's Coffee House, that was founded in 1688, and it became the center of the maritime insurances. And there are some certain standardized procedures for shipbuilding, for instance, why in the United States, sockets for electricity in a certain shape. It was the insurance companies who made the standards. So insurance company as the were most characterizing this whole industry, and better accounting and control systems. And if you see that, this must be Cape Town in the background, I suppose. That's the mountain there. So this is a vessel of the VOC of the Netherlands East India Company, founded in 1602 in Amsterdam. And I will not show you the graph where all this is explained. And that's the 7 provinces of the Netherlands were funding this. And there were also some messenger ships who could say how much pepper was on that one ship, for instance. And then there were other people involved. And then there were inheritances. And then the stocks were divided. And then they made options and futures and everything. So everything we see today as financial speculation was emerging at that time out of necessity, because they had to build up a working, functioning stock exchange and market. There is a good book about the history of the stock exchange in Amsterdam, and those people were so really exciting or interesting that my wife and myself, we were in Cape Town last year, and there is a vegetable garden. It's called the VOC Vegetable Garden, and I think it's so great. At that time, they actually built up a vegetable garden there, and if the colonial ships could come by, they could get their provisions there, and then they could go on sailing to Java, maybe. Unbelievably, the way they actually looked into the future.
So, I should better have listened to Mrs. Rücker. This doesn't really look good. So they all said, okay, I should enhance the text, but okay, approval from my team. Okay, that is great. So I'll get to modern times. So very interesting is the topic of swaps. How can I transfer risk from one person to another? So don't look at it, I'm going to tell you. So IBM and World Bank in the 80s, they both required credits. And one in one currency, the other one in another currency. And they said, okay, well, you just take a credit in your currency and I will do in mine. And we are then going to switch the yield fluxes. And like that, swap transactions were created, which are standard today. And so they said, okay, I have those fluxes that I want and I have those that you want. So we're just going to switch it. And then we've got the topic of credit derivatives. And at the beginning of the 90s, I was astonished when my colleagues from McKinsey told me that actually the interest risk can be separated from the risk of failure with derivatives. So I'm giving a credit to company Y, and the base interested is in the stock market, but I want more money, and this more money, this can be hedged by credit default swaps. And so you separate the risk of failure from the risk of the credit provider. This was very interesting and was used excessively also in the big financial crisis of 2007, 2008. So this system was abused, but it held. The big failures in the financial crisis of 2008 were settled at HC in New York. So the derivatives were fulfilled, and those who had a derivative, they got their money back. So in the end, this was successful, but it was abused nevertheless. Okay, then also I can hedge. So already in Mesopotamia, the first insurances existed. Maybe the Hamburger Feuerkasse is interested because it was founded in 1676. It's the oldest insurance in the world. And then I think it's Generali down there. Yes, so Generali, one of the big insurance companies in the Mediterranean area, was founded in 1831. Here too, also like that, you can get rid of risks. What I find interesting is if you want to invest in insurances, then you have a table like this. Did anyone of you have a look at that in the annual statements? So Tom Gaynor just recently said, or last year said, this is the most important table in the entire annual statement, also the biggest figure that you have in the annual statement. And you should just have a look at that for insurance companies, and then you will see Markel in the year 2015. They have expected risks of $1.7 billion. In the year 2016, this was reduced to $1.6 billion. And again, it was corrected downwards. And today we're at 1.457 billion of risks. So if you look at such a table over the time, then you see when an insurance was too aggressive, then these provisions are being increased, or if they were too cautious, then these provisions can be reduced. And so all of you who deal with insurances, for those of you, this is the most interesting table in the statement, because you see what kind of errors have been made in the past. So another aspect of how to get away from risk is if you plan in longer timelines. So again, mathematics here, so you know that company growth is an exponential function. So first year 10%, then you have 10% on those 10%, so 21%, then 32 in the third year, so this is an exponential function. So here I have a positive enhancing effect the longer I wait. The risk does not rise in the same way. The risk actually goes down with the length of time. So after 2 years, I don't have the double the risk, but only 1.4 times the risk. And for 4 years, I have double the risk. And well, this is basically. So you take the square root out of the time, and so for 9 years, it's 3 times the risk and not 9 times the risk. So risk is actually vanishing over time, and the company development or the stock development is going up exponentially. So those of you who have time, they should use that, because that provides you with chances for earnings. And so if I don't have time, I can't take the risk. If I have 30 years, or I don't know, how is it called? These children's pension, so these 10 years. So if I have that for over 60 years, then you can take whatever risk in stocks, because this will, because the probability that this will fail is close to 0. Here, displayed that's on the stock global fund, so taking out risk. So this is always good for a good quotation. Israel and Egypt, the 7 bad years, and so having stocks is good too. So, but how much money should I put in Berkshire and into Markel stocks? So there are people who calculated that. There was a Mr. Kelly in the 50s who calculated that, and an Edward Thorpe who also wrote an interesting essay concerning that. Edward Thorpe was a financial expert who liked to play blackjack, and he always tried to see what is the best betting size that I need to take. And so this is an excerpt from from one of his articles. Back then, the graphics were not that nice. There is an optimal point where I never can get bankrupt and can maximize my earnings in the long run. I think this is incredible. This is the formula for yes and no bets. So very practically for us. So what kind of probability do I have that I'm going to beat the market in the next month? P. And just guess how high this is for us. So if we have a great year, then we're at 53%. And magazines always say 70-80% of securities, but we have 53% in the best case that we are better than the market. And this is really an enormous amount of return. And in bad years, we've got 49%. More is not possible, and I don't know of any companies who have more. These are small figures. And now the question is, how much of my portfolio do I put in a stock if I only have 51% of security? And so there is a formula. We have this win factor. P minus Q is the probability that I get the yield, the return, that I do more than the market. This is 2%, and for 2%, I should also have 2% of my portfolio for that stock. This is the optimal amount to maximize earnings without ever going bankrupt. And then it gets interesting for stocks itself. I've got the expected value of return. We had the 9 and the 11% before for Berkshire and for Markel. And here we have the risk-free interest rate and the volatility. So the And if we look at that for Berkshire, I'm calculating with 9%. Currently, I'm deducting the market interest rate, and so in the end we will get 2.0. And here it says, okay, take a credit and put double your money on the Berkshire Hathaway stock. And this is a fascinatingly high number, and with that I will not be able to maximize my earning in the long run. And this is the maximum. And so here we see what we can do, and here we can see what can happen, what kind of fluctuation do I need to accept. And also we did the calculation for Markel. Down here we've got the Berkshire, and for Markel it's around about the same figure, and the risk and the reason is that volatility of the stock market is just higher, and that's why we have the 1.75 times your money that you should put onto that stock. But we have a broad portfolio with around about 50 stocks, but if you calculate that for one investment, there you'll have very high figures if your assumptions are correct. So, conclusion. So if you don't have time or expertise, you should hide your money under your pillow and have it eaten up by inflation, or just use a counselor, investment counselor. If you have a vague knowledge of stocks, you can use broad diversification, and the more knowledge you have, the stronger you can take individual decisions for individual stocks and for funds. You can also, and for private equity, venture investments, and also real estate, the bandwidth is really high between good and bad funds, and so the yield can be extremely high. Risks that you can't bear can be insured, and the risk allocation can be very high. So this is my short presentation, mathematics and history. I don't know. To me, that helps if I keep the entire picture in mind. But now I would like to talk about the speakers today. So I also talked about insurances. So we will have Tom Gaynor today, who is CEO of Markel Insurance. To me, it's the small Berkshire Hathaway. So maybe the successor of Berkshire Hathaway with higher yields, smaller and more agile. And Tom Gaynor, the CEO, has come here from Richmond, Virginia, only for this conference, and after this conference he will return to the US, and I'm really happy, or I'm really interested in what he has to say about his small Berkshire Hathaway, his Markel Group. Then we have Professor Lars Feld, earlier time of the expert committee, a long-time counselor of Financial Minister Lindner. He talks about German angst. So why are we Germans so anxious when it comes to risk? Why do we think that the euro is so safe, safer than a good stock? Why are we that strange? And then another one of our products that we want to present to you is, and so David Hudek will talk about our Small Diamonds Fund, so where he searches the infinite depths for good stocks who have a good performance. Then we have two presentations this afternoon concerning venture capital and why. So I'll get back to the year 1995. Why is Amazon actually? Why was Amazon created in the US and not Germany? Karstadt-Quelle back then had an extremely good website, and the project was killed internally. So this could have become Amazon. Bertelsmann back then had a book platform. Why did they not make Amazon out of that? Why are we so afraid of risks and scaling them up for a decade? So it's good that we're doing something against that. Dr. Jörg Goschin has worked for companies like Boston Consulting, so top-notch companies, and then he decided to work for the KfW, so a state-owned institution, and he does co-financing of small companies. It's really interesting to see what they build. So actually, we're not that stupid in Germany, and KfW really is also helping here. Then we also have another venture capital presentation. We've got Rasmus Roth from Rantex Capital. He reports on his innovation lab in Berlin. He finances German companies who use AI for practical use cases, so they make it usable for individual industries. I don't know whether Ms. Jenkins is here. From the company Quantum Light. She wanted to be here today, but well, they are doing the same thing from London with a mathematical approach. And so today we've got lots of information about venture capital. And then we've got Nicola Winter, who will talk about risk with jet pilots. And I asked her, do you need people who have this need for adrenaline? Because she's also an aspiring space traveler. And she said, well, these are the entirely wrong people. Those people who are looking for adrenaline, they should not get into high risk areas. And she worked for McKinsey. And she said, well, what is interesting is that in the financial industry, debriefing what has gone wrong, that this is so unusual. And she will talk about how you understand what kind of risks you had, what kind of errors you made, and what you can take away from that.